One of the largest regulators in Canadian real estate, OSFI, or the Office for the Superintendent of Financial Institutions, has just proposed some major changes for Canadian real estate, and it actually could end up screwing over both people who are looking to get into the market and people who could be selling in the next 5 years. So let's get into the info and talk about what these changes are and how they could impact you directly, and make sure to subscribe to the channel if you haven't already done so. So we're talking about OSFI. This is the Office for the Superintendent of Financial Institutions. This is the regulator of Canada's big banks, the big banks that give out mortgages. This is why it's so impactful on Canadian real estate. Now, OSFI has something called the stress test, which was implemented back in 2017, and that stress test forces people to qualify for mortgages at a higher rate than the one that they're actually getting, to make sure that if they lost their job, or if the house prices went down, or for whatever reason they couldn't pay their mortgages, that they actually had a little bit of a sort of a buffer zone in there, making sure that they could afford a higher payment than the one that they actually were going to need to pay once they got that mortgage. Now, this stress test was largely a good thing. Without it, we would have seen Canadian real estate prices explode even more than they did over the past couple of years. But now OSFI is a little bit worried that they haven't gone far enough to protect these big banks from systemic risk due to extreme mortgage lending. And that's what they start saying here in the report that came out just this week, saying in recent years, risks in the Canadian residential mortgage market have continued to build. Unprecedented house price increases have been accompanied by record levels of household indebtedness, of which residential mortgages account for a large share. Federally regulated financial institutions, the big banks in Canada, which hold approximately 80% of all of these mortgages in Canada, are exposed to the heightened risks from this indebtedness. So because of these risks and worries that OSFI has, they're proposing a whole set of new rules that would apply to Canadians who are trying to get a mortgage that would likely make it a lot harder to. The first proposed change is to implement a hard income to debt cap, so making it so that the debt that you can take on to get a mortgage is directly tied to your income in terms of a specific multiple. And the multiple that they are proposing is a 4.5x limit. Now, to make this extremely simple to understand, if you had an income of $100,000 or a joint income of $100,000, you would be able to get a mortgage or debt of no greater than $450,000, right? That 4.5x multiple. But instead of making this cap apply to every single mortgage borrower, instead OSFI is proposing to let the banks decide who to apply this cap to. As we can see here in this recent Globe and Mail article, they say that OSFI may require banks to ensure that no more than 25% of their mortgages have a loan amount that's greater than 4.5 times the borrower's annual income. So it wouldn't apply to everybody. The big banks just have to make sure that no more than 25% of the mortgages that they have on their books are in over this range of 4.5 times their income. But how will they decide who to apply this cap to and who not to apply this cap to? Well, it's likely related to the type of loan and the type of person that they're giving the loan to. The first one would be obvious, a credit score. If a person has a good credit score, then maybe you can trust them to go past that 4.5x cap. But the other one is likely the loan to value ratio on the mortgage that they're giving out, essentially comparing, okay, how big of a loan are we giving out relative to the total value of the property? Like if you have a 50% down payment, right, then your loan is a far less portion compared to the value of your property, and as a result, the bank might see less risk there and let you sort of inch past that 4.5x cap. The next thing that they're proposing is a change to something that they already do. You might be familiar with these two acronyms, GDSR and TDSR. They stand for Gross Debt Service Ratio and Total Debt Service Ratio. Essentially, it just compares your income to your debt. This one is specifically just the debt of your housing costs. This one is all debt costs, including credit cards and cars and other things like that. Right now, there is a hard limit on what these percentages can be, specifically for insured mortgages where you put down less than 20% and as a result have to pay for mortgage insurance. And these hard caps are 39% if you're for your gross debt service ratio, and 44% for your total debt service ratio. Essentially, your total debt payments can't be more than 44% of your income when sort of carried out across the entire year. But for uninsured mortgages where people are putting putting down 20% or more as a down payment, there aren't really any hard caps on what these percentages have to be. Instead, each individual bank has to make the decision on what fits their risk portfolio, right? If you have a really high percentage, it's more likely that that person's going to default on the loan. So they kind of let the big banks decide and let things even out over time. In practice, usually the GDSR is around maxed out at 44% for these uninsured loans, and the TDSR is sort of maxed out at 48%. Now, the big change here is that they could potentially consider changing what these percentages are for uninsured or for insured mortgages, but also that they may impose a cap on uninsured mortgages as well, meaning like perhaps they could put this at 39%, perhaps they could lock this at 44%, just like they do for insured mortgages, sort of restricting the amount of financing options that the Canadians have as a result of this limiting of the debt service ratio. And the final proposed change actually has to do with the existing stress test, making a change to that. The stress test is also known more formally by the OSFI as the minimum qualifying rate for uninsured mortgages, and it has a specific rule for how you can actually get a mortgage. You have to qualify either at a rate of 5.25% or at a rate of whatever your bank is offering you plus 2%, whichever is higher between those two numbers. So back a year ago when we had super low mortgage rates, maybe it was around 2%, well, you wouldn't be qualifying at 4%, right? Adding 2% to the amount that you could get from the bank. Instead, you would be just capped or like pushed up to the absolute minimum rate, which is 5.25%. Now that we're in a sort of time when average rates are over the minimum here, the 5.25, like if you're getting a rate of 5.5, well, then you actually have to qualify at 7.5 because that's sort of adding the extra 2% on here, and that is the greater number between 7.5 and 5.25, right? Now, the change that they're proposing is they might actually play around with these percentages. They might actually increase this number and they might increase this number as well. But additionally, they might make it so that this number is different for different types of mortgages. Perhaps you could have a different minimum qualifying rate for a mortgage that has a 1-year term versus a mortgage that has a 5-year term. So they're proposing that they could play around with these numbers as well. Additionally, OSFI also indicated that they may consider applying a stress test to other types of consumer debt. Traditionally, this has been just for mortgages, but now they're actually talking about applying this to Canadian auto loans as well, especially as we've seen auto loan delinquencies or people not paying their loans increasing. In a world like this, we'd have it so that when in these periods like 2021, where we have extremely low interest rates, even for cars, people will have to qualify at a higher interest rate than the one that they're actually going to be getting, assuming that potentially in the future they might need to roll that loan into a new one that could, if the conditions change, be at a higher interest rate. If these changes are implemented, it could have a big impact on Canadian real estate, and we're going to get into that in just a moment, but even before any of these changes are implemented, we're already seeing a downward pressure on prices of real estate in Canada due to high interest rates, and home affordability is also down despite these lower housing prices. I'll move myself over here. If you've watched the channel for any amount of time, you'll likely have seen this chart before. This is the House Price and Affordability Index put together by the Bank of Canada. The blue line represents the price of homes, while the yellow bars represent how affordable those homes are. A higher number means that it's less affordable, and we can see here in the most recent period here into quarter 2 and 3 of 2022, while we've seen house prices dip, at the very same time that house price affordability is getting worse as well, as that sort of rate is going up. Obviously, this is because higher interest rates determined by the Bank of Canada results in higher mortgage payments. Even though house prices are lower, mortgage payments are higher on those houses. Now, there are a bunch of people that have been in Canada sort of sitting on the sidelines wanting to get into housing, waiting for a period of declining real estate prices, claiming that they'd swoop in when the time was right. But the implementation of some or all of these changes will make it a lot harder for these Canadians to qualify for a traditional mortgage. So for some, this is the time that they've been waiting for to buy a house. Prices are lower. Perhaps in a year, the Bank of Canada starts to lower interest rates again, and houses get actually a little bit more affordable. But then at the very same time, OSFI is introducing all of these sort of new measures that will make it harder for them to qualify to get the home that they've been waiting for. And since these regulations will only apply to Canada's biggest banks, well, the idea is that, hey, this could push people towards less traditional financing routes, ones with higher interest rates and higher fees. This is something that Benjamin Tal from CIBC is also concerned about.
And there are basically saying that they're going to review it once a year. We are putting a lot of pressure on them. I'm not saying cancel it, but I'm saying adjust it to reflect where the market is.
Yes.
And I think that there are many ways of doing it, because the way it is now, it just doesn't make much sense to me, quite frankly. And what the issue is that people will go to alternative lenders and pay even higher interest rates. So you increase the risk in the market by doing so.
When you're able to qualify for what we call an A lender, these big banks, CIBC, TD, RBC, it's harder to qualify for that mortgage, but you get a lower interest rate and you're not charged as many upfront additional fees. Now, when you turn to a B lender, like a credit union or some other alternative financing method, well, oftentimes because you're not as qualified for a mortgage, especially in the terms of qualifying for an A lender, these B lenders will say, okay, well, if we're going to take you on, we're going to charge you a higher interest rate, and also we're going to charge you some points up front or some additional fees that are relative to the total amount of the loan. This could be like a 1% fee on the entire value of the loan. So if that's a $500,000 mortgage, you're charged an additional $5,000 just for going with this alternative lender. Now, OSFI isn't all that worried about it, as we can see here in this Globe and Mail article. OSFI suggests that this is an immaterial risk for the banks it regulates, but if you're the borrower assuming the risk, it's material. So OSFI isn't all that concerned because they're just worried about the big banks and making sure that their mortgage practices are sound, not really caring about the end borrower and whether or not they're actually going to end up paying more because of these new regulations. Now, if you're someone that's looking at selling their house in a time when prices are already down, these changes could push them further down. At the very least, it's a pressure on prices to go in the negative direction. Well, it certainly isn't ideal if you're trying to sell your house, and it's especially not ideal for the people who bought at the top of the market and now are watching their mortgages go underwater into a situation where the amount they owe on the property is greater than the amount the property is actually worth today. But ultimately, things aren't quite as bad for people who already own real estate as long as they're not forced to sell, because in Canada, we kind of have this backstop on how low real estate prices can go, and that is our incredibly high, at least relative to other countries, population growth. In the period between 2016 and 2021, Canada had a far higher population growth rate than some of our sort of comparable countries, right? We can see here, the United States had a rate of 2.6% growth each year between 2016 and 2021. France had 1.2, Germany 1.0, the European Union 0.5%, and Canada's sitting here at 5.2% population growth over that period of time per year. This is especially interesting when you look at Canada's birth rate, which is lower than comparable countries, sitting at 1.4 births per woman, while the United States has 1.64 births per woman on average, and Mexico is at 1.9. Now, having a low birth rate, but also some of the highest population growth might not make a lot of sense until you consider Canada's immigration policy. Recently, the federal government has announced that they're targeting 500,000 new Canadians to come into the country each and every single year. Now, comparing this rate to other comparative countries, especially looking at the States, we can see what the difference is here. By 2025, Canada will admit 12.5 immigrants per 1,000 residents compared to the United States policy, which is welcoming 3 immigrants per 1,000 residents by 2025. So this more aggressive immigration policy and immigration targets, it can kind of act like a backstop on Canadian real estate prices, because for every new Canadian you bring into the country, that person needs to live somewhere, right? So this is something to consider. Now, when it comes to all of these new guidelines, new rules proposed by OSFI, it's expected that the final guidelines, the certain decisions that they're making, will be out by the summer and will be implemented at some point after that. So that'll be interesting to watch to see where these things all land. But everyone wants a world where we don't have mass housing foreclosures due to unsustainable mortgage lending practices, which is the point of why OSFI is doing all of this, making all these changes, making it harder to access credit for mortgages for Canadians. But is this extreme level of risk management worth shutting the door on young Canadians who are trying to get financing to purchase a home? I'm not sure, and I'm curious what you think about it. Do you think that these rules are right, or maybe they should have been implemented even earlier before we saw this housing boom? Or do you think that OSFI is going the wrong direction with things? Either way, let me know in the comment section below. I read every single one and try to get back to as many as I possibly can. If you want to check out all the sources used for this video, you can check that out in the first link in the description. I send them out at the end of every single week, so you can check them out there. But with all of that said, thanks so much for watching, everybody. Really hope this video helped you out at least a little bit, and I'll see you next time.